Welcome to the daily update, where I'll go over the action in the market for Wednesday, February 19th, and we'll see how things look for Thursday, February 20th. Well, set another new all-time high and can't be much more positive than that. We're not really looking at a blow-off top. And what I'm referring to is what happened back in the year 2000 is when, especially with the NASDAQ, it was just going up and up and up, and people were throwing their money towards the market, and it would double every few months. And then we had one day where we just shot really higher. Things were just euphoric. And then we ended up closing well down off of that high. And that was pretty much it. That was the beginning of the dot-com bust after that. We're not really seeing that right now. And of course, there's a lot of differences between 2000 and what we're seeing now as well. We've got earnings behind these companies, and these are companies that have been around a while and have established themselves. Where back in 2000, these were brand new companies, and if they had .com after their name, that was their whole selling point right there. Anyway, we're seeing the smart money still coming in and buying. We're looking positive. We're switching more positive with our primary indicators. But as always, there's some things to be concerned about here. Okay, so right at the open, we did have a lower open. We were down about 1/4%, and Europe ended up having a pretty down day. After setting an all-time high in Germany, they fell back after that. Prices then chopped sideways before breaking above the daily pivot at 61.20 and then chopping above and below the unchanged level. So during the latter part of the open, we really didn't see an awful lot of conviction. Then we did see some late day buying coming in, and that's the smart money coming in and doing what they want to do. This took prices above R1 at 61.40, and we closed at a new all-time high above R1. And this is interesting. We were up 0.24% after Tuesday. We're up 0.24% after Wednesday. The same exact percentage amount. Nothing really crazy about that, just kind of ironic. We were above average with volume, and we are positive in the short, intermediate, and long term. We're seeing the short-term momentum pick up steam, and we're not getting too many indications in the intermediate term. The thing that we're watching still is that we're not trending in the intermediate term, but we are positive there. And then all the different geopolitical things going on, talks between Russia and the US about Ukraine, and some tiffs that have developed between Europe and America, and of course, all the things going on in America with Doge and all that other stuff going on, and the executive orders, and as well as confirmations that still need to happen. And it's got everything all kind of in a not really a mess, but depends on what side you're on. You really love this or you hate it, depending on what's happening. But the market doesn't care about that. They're starting to realize, okay, this is the new norm, at least for this period of time. And so we're just going to come in and do what we're going to do anyway. Some comments, we did set another new all-time high, and this was more conviction was behind this because of the late day buying. And the mega caps outperformed, but growth, we're seeing that trailing off a little bit. Now, growth had been doing well. And so a lot of the smart money, they've already come in and bought their growth areas that they want. And now they're just letting them ride. So there may not be a lot of additional buying going into that, at least up to this point. And the markets are starting, instead of freaking out every time President Trump comes out with a tariff, they're just saying, okay, yeah, we finally reread The Art of the Deal that he wrote years ago. And it's like, okay, he comes out and he says these really big picture, even crazy things sometimes. It's to get you focused on that instead of what he's really trying to do. And now they're seeing these tariffs more as a bargaining chip rather than something that's, oh my gosh, everything's gonna freak out and it's gonna change and inflation's gonna go through the roof. And then referring to the tariffs, Trump did come out and say that the auto tariff, it will be about 25%, and that'll be looking to start around April 2nd. Again, we'll see if something else gets negotiated in the meantime. And he's also considering tariffs on pharmaceuticals and semiconductors, and a lot of that includes China. Then the FOMC meeting minutes did come out, but there was nothing really surprising. The market already knew these things. Chairperson Powell had already spoken about these things. So there really wasn't anything for the market to react to. If anything, that's when things turned a little bit more positive since there weren't any surprises that came out there. Now, in the short term, we are seeing pretty good momentum. We're starting to get extreme here with the Stochc RSI, the Williams percent R, CCI 1420, and the stochastics. Now, that's been that way. And there's one way to look at it. It's like, oh my gosh, maybe we're due for a pullback. And that could be true at any time. But when you see a lot of these indicators all coming together, giving us extreme readings at the same time, especially when the longer term trend is still positive, we take this as good momentum. Even though we're not trending, we're still seeing a, a positive side of momentum right now. And then we have our three smart money indicators: accumulation distribution, the Chaikin money flow, and the Chaikin oscillator. Those are improving, but they're also looking really extreme right now. In the intermediate term, one thing that was added to the list, actually, there were two things here. The balance of power, that was on the list a few days ago. It dropped off. Now it's back on. The Arun, which seems to just kind of be comatose a lot, and then all of a sudden it kicks into gear, it's still giving us an extreme positive reading. The Sean trend meter did tick up, and that's getting into the further extreme area. And I'll show you charts of all these. And then the ultimate oscillator, one of our secondary indicators that we look at, it's starting to get extreme. No change to the scenario right now. The market is still anticipating a soft landing, meaning that we will not go into a recession. And in the meantime, the Fed has paused cutting rates. The dollar was up and interest rates were down. And now you're going to look at this and go, wait a minute, they're unchanged. Well, we rounded down to 4.54% after Tuesday. We had to round up to 4.54% after Wednesday. So that's why the this goes out many decimal places. I just round it to do two decimal places here. But we're still above that 4.5% level. As I've also been saying, there's nothing magical about that. It's when you look back, when did stocks start not really moving to the upside? It's about the time we hit the 4.5% level with the 10-year yield. And that really has slowed things down and sent us into this non-trending environment without necessarily turning negative. And sentiment is neutral. We ticked down one notch to 48, where we had been at 49. So we're kind of right at the tipping point there. And we're still not trending, but we are positive. The green line is above the red line. And then I'm still keeping it mixed to positive, even though we're setting another new all-time high and we're showing some improvement. We're not seeing a lot of real conviction going on right now until we can really break out of this non-trending pattern that we've been in. And we're also mixed to positive with the momentum. Now, the bias is usually one day, where the momentum is usually the last two, three, four, five. I just kind of take them together. And this is subjective. I come up with this, where I try to let the rest of this video just show you the evidence and look at different ways to interpret that. Okay, so we did get housing starts, which were down 9.8% on a month-over-month basis, and we're falling a bit when this SAAR, that's annual. And we're looking at 1.366 million. That's lower than the 1.4 million they had expected. The last time we had this report, it came in on an annual rate of 1.515 million. And some of that could be rising interest rates, some of that could be concerns about the tariffs. And so we're seeing a bit of a slowdown there. The building permits, though, and this is also forward looking, they were up 0.1%. And when you annualize that, it's 1.483%, excuse me, million, a little bit under the 1.45 million that they had expected, and also about the same, a little bit higher than the 1.482 million we saw last time. Every week we get the mortgage application index here. It was down 6.6%. Last week it was up 2.3%. Purchasing, people are getting a mortgage to buy a house, was down 5.9%, and refinancing was down 7.3%. Okay, so here's a chart, the mortgage applications. We had seen a couple of positive weeks, and now we saw a negative week. Housing starts. What this does is on this chart, it takes a 3 month average. And they are going up with the building permits and the starts, but the starts are kind of starting to flatten out here where the building permits are still going up from previous stronger readings. And on an annual basis, we are dropping down here with the housing starts. Then every week we get the overbought, oversold composite together. We're getting in at 78.37. Personally, when we get into the 80 range, that's when we start to really take notice here. And then we're really getting overextended to the upside if we get up into the 90 range. And we're not there yet. So this is also kind of confirming fairly good momentum that we're seeing. This is a chart that says don't fear new all-time highs and put out by Carson. And it's really hard to read this area, so I try to blow it up and it's still blurry. I apologize for that, but I can't really do a lot of manipulation with this graphic. But this just looks out, okay, when we set a new all-time high, what do we look like 1 month, 3 months, 6 months, and a year out? And it's not 100%, but the further out you go, generally the better the percentage is that you'll be higher at that point, and it also points out the average returns, both the average and the median. Okay, now we're seeing a bit of a disconnect here. The purple line is the S&P 500, and this is the truck tonnage index, which going back to about the COVID crash, we're seeing that this is really slowing down a lot as the market has been going up, where they had been really going more hand in hand with each other. I don't know, are drone deliveries that big of a deal? And they're not buying big trucks, they're sending it out via drones. But this is just something that we've been watching for quite a while, and it's just showing more of an overall shift in the economy with how things are delivered or how they're transported. Okay, concentration of the S&P 500 market cap and earnings in the 10 largest. Okay, and no big deal here. The market cap is 38% and earnings account for 28%. That's where the real strength is at. In the 10 companies, of course, there's the Magnificent Seven, the Great Eight, the Illustrious 11, whatever you want to come up with there and however you want to measure this. And looking at when you compare things on a world basis, we're seeing a real drop off in US stocks. That's the S&P 500, which is the dark, I guess you could say it's black here. And we're seeing some money really going into Europe right now. Europe's been doing quite well, and we're setting all-time highs with the German DAX. But we've been watching that for a bit, and we're wondering, okay, now that everybody's starting to realize this, is the party about over, at least for the time being? And you can also see money going into emerging markets as well as into Japan. This is what the market thinks inflation will look like going forward, and we are seeing that going up here. And we're seeing commodities going up, excuse me, commodities going up, and the economy seems to be doing quite well. We get economic reports from time to time that cause some concern, like retail sales last Friday. But we look at PPI and CPI, and that's why we're seeing a lot of these projections going out for inflation going up again. And I'm not sure how useful this chart is. It says the S&P 500 has gone mostly nowhere. That's why we're not trending right now. But we did set a new all-time high after Tuesday and another new all-time high after Wednesday. And we'll just see if at some point we get into, excuse me, a trending mode. You gotta love it when I do all these videos, take one. So you have to deal with my stumbled words and clearing in my throat. This is something that I show over the weekend. This is looking at the Fed balance sheet. And this is pretty much a mirror image of what I've been showing for a long time. We topped out here, and then it was June of 2022 when the Fed said, okay, we're going to do quantitative tightening. Now we're going to let things fall off of our balance sheet here. And then it also compares some other things that have been going down as well. Okay, then how has the market performed since election day? It's been not all that great, but it's not falling apart either. So it depends on your perspective. It's like, oh, I wanted the market to really go up here. Okay, well, it hasn't really done that, but it hasn't tanked the way a lot of people thought it would do that. I didn't spend any time on Twitter now. Here's the intraday chart. You see the big spike that we saw up right at the end of Tuesday. That kicked us into a new all-time high. We did open lower, but then we kind of clawed our way back. We chopped along the unchanged level for quite a while. And then after the meeting minutes came out, we saw a little bit of a bump up here, and we got up above R1 and ended up closing a bit above R1. And we're up just a little bit in the initial overnight session here. Still looking good when we look at the intraday chart of growth versus value. Blue is above the red. But we're trailing off here. We haven't turned negative. We're still kind of keying off of this late January bottom that we saw here, and we've been going up overall. We'll be keeping an eye on this, though. If this really starts to fall, that may mean that the characteristics of the market are changing a little bit. We want this to go up when the market is more positive. That means the smart money is coming in and buying growth stocks, and growth stocks are what make the indexes go up. End of day, growth was up, but quite a bit less than value. It was down more for the mid caps and down less for the small caps. So on an end of day basis, we're trailing off a little bit here. We're going sideways with the small caps. The index just hasn't done anything. It was supposed to be going up really solid right now. We get a couple of days where it looks good, and then we go sideways, and then we start to drop after that. And so we're seeing a little bit of weakness here with the growth to value ratio. Coming down a bit with the growth to value ratio with the mid caps, another index that just has not done very well lately. And trailing off, but still looking solid here with S&P growth to value. And coming back down a little bit further inside the rainbow, when we look at the growth versus value ETFs, and discretionary to staples coming down a little bit, but still looking pretty solid overall. A lot of that has to do with recent weakness in Tesla. Large cap growth, though, very strong here, still above its 50-day moving average, but not setting a new all-time high. The condition of the trend still going down, possibly starting to bottom here with the ADX, the black line. This doesn't measure direction. This measures how strong is the trend. So when this line's going down, the trend's getting weaker. When this line's going up, the trend is getting stronger. We have not been able to cross back above the moving average, at least yet. We are positive because the green line is above the red line. Short term, we are seeing more of a bottoming process here. Haven't really turned up yet, but at least we've stopped going down. And we're also positive here in the short term. And we were above average with volume, sentiment. The VIX hasn't been moving all that much lately. We were pretty much flat, both on a closing basis and with the bar chart. And we're underneath the moving averages here with the VIX of the VIX, the volatility of the VIX, falling a bit further below the moving averages. The momentum for the VIX still continues to be down, getting an ultra high reading. We've never had a reading this high with the skew index, which is a variation of the VIX. And the idea is that when we get up into this red area, the market is expecting some kind of a big move. We just don't know if it's going to be to the upside or downside. And I've tried to point out other times when we spiked and then what the market did after that. Sometimes it marked the top, sometimes it marked the bottom, sometimes just a continuation. But we're still getting a really high reading with this. We were up with this fear gauge, we were down with the other fear gauge. So a little bit of a contradiction there. And I didn't get any of the equity put call information. I waited and waited. So these are yesterday's charts here. And going up a little bit, but still in the band when we look at volatility risk premium. So we're seeing a little bit of an increase in fear according to this chart, but it's not really getting too extreme yet. The advanced decline line is looking good, and we're even looking better when we calculate this based on volume. We have not surpassed this previous high set back in December based on price, but we're setting all-time highs here based on volume. And this, as I've been trying to point out over the last couple of days, this could be positive where we're seeing volume leading price. And we're improving here with the advancers decliners over 10 days. We're back above zero and going up, so that's turning positive. And we're improving a great deal with the new highs, new lows, another internal measure. We're starting to turn back up with our 5 day and we're going back up with our 10 day. And we're seeing a lot more green here than we are red. Green are new highs, red are new lows. And here's smart money indicator number one, continuing to go up above the advancing moving average. We could be getting far away, but I've been saying that for a number of days now, and this continues to go up. The advanced decline ratio above zero. The blue line is short term, the red line is intermediate term. We are positive there, and we're getting a really high reading, even though we ticked down a little bit with the tick and money flow. The histogram here, the green part, we're still going up with the red line, so that's positive, and we're getting a very extreme reading here, higher than what we've seen on this chart with the chicken oscillator. This is another smart money indicator. And the vortex didn't really show much of an improvement, but we are positive. The green line is above the red line. And this is another chart. Look at the cumulative advanced decline line for the S&P. Based on price, doing okay, not breaking out to a new high yet. That's not a confirmation of the all-time high that we set, but we are breaking out to an all-time high based on volume. And then we look at the cumulative advanced decline line for the NYSE, holding up okay. And the regular NYC advanced decline line is doing all right. It actually declined a little bit in Wednesday's session, and not really much of a change here. But we are positive with this NYC advanced decline line as well because we're above this moving average. And then we break it out based on volume. This is where we're seeing some strength. We're not seeing that confirmed based on price. Now, that could be a negative divergence, and you could say, well, we're not getting there. Price is the ultimate indicator, which is true. But the fact that volume is actually going up where price hasn't done that, at least yet, that could be taken as positive. Advanced decline line studies looking pretty good here. Declined a little bit on the NYSE common stock, up a little bit here with the S&P. Declined, but still above the moving average with the mid caps and coming back down to the moving average with the small caps. This is improving as well. The stocks inside the S&P above their 20 period moving averages, above 50 and going up. Now that's shorter term and that's positive. But you also see here that we've been going up with the S&P 500 index, but this has been going down. That's longer term, a negative divergence. We want to see this improve more to negate this negative divergence that we're seeing. Also improving here with the 50 period moving average study, the 100 period moving average study, and the 200 period moving average study. All right, so we were above average with volume, setting a new all-time high above. We're getting ready for the March pivot points to come into play here. We're getting near the end of February, and so that makes it a little bit hard to see here. And a little bit of an improvement with the 20, 50, and 200-day moving averages, even though they were fairly flat overall. But this is where we're seeing the more positive momentum in the short term, with the Stochk RSI giving us a really high reading, as is the Williams percent R, the CCI 14, and the CCI 20. All the stochastics are looking extreme now, short, intermediate, and long term, which is a further subdivision of the short term time frame. The force index is above its midpoint and positive. The condition of the short-term trend, we're still going up with the lines. We're above both of the lines. That's positive. We're above the simple and exponential moving averages. That's positive. We're up into the +2 channel with the standard deviations chart. That's positive. We're starting to get extreme here with the balance of power. We had become extreme, then we fell back. Now we're going back up into that reading. But that's positive, but maybe looking a little too positive. CMB composite getting very close to giving us an extreme positive reading here. The go no go is still positive with the dark blue bars. We're coming up above this highest high value, the blue line. That's positive as well. And we're seeing an improvement. The TTM squeeze had been coming down. Now it's turning the lighter shade of blue, so it's seeing some strength now. And we're right about at zero here with the ease of movement. That shows there's really no advantage one way or the other. Here's the Arun where it just was asleep since the end of January and then shot up, and it's giving us even more of a positive reading now. And what this does, the green line, that's buyers, the red line are sellers, and then the oscillator down here measures the difference between the two. The S&P McClellan oscillator above zero and going up. You could also make a case that we were going up with the S&P, we were going down with the McClellan oscillator. Longer term, that could be a negative divergence. And we're going up with the summation index based on price, and we're looking even stronger based on volume. We declined, but still above zero with the NYSE McClellan oscillator, but we're still going up with the NYSE summation index based on price and volume. Not really seeing much of an outperformance here with volume for the NYSE. We're seeing that more for the S&P 500. Swindler Trading Oscillator advancing above zero based on price and volume and looking stronger based on volume. The momentum, after trying to come down and turn negative, no, we've been able to turn back up here with the PMO. We're turning back up based on price. We've already been positive here for a while based on volume. And this is, again, this scenario that we're seeing where volume has been stronger than price. We're going up with the PMOs that are rising. We're going up with the buy signals, but we're still flat with the PMOs that are above zero. We are positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR since the dots are underneath. We're positive in the intermediate term based on 50 periods. We're above both the blue line and the red line. Now, if we can stay above this, and if the red line can get above the blue line since it moves faster, that would mean some momentum is coming back into the intermediate term. And we're above the simple and exponential moving averages. Kind of the same thing here. The blue line, which is an exponential moving average, which moves faster, if it can get above the red line, that would suggest momentum is coming back in intermediate term. We're above all the moving averages here and setting an all-time high, and all the moving averages are back to going up. The slope oscillator is still negative. It's turning up, but it hasn't quite crossed above its moving average. We are positive, though, with the MACD. So we look at the slope, that's trying to improve. The TSI, the other short-term oscillator, it's back to going up. And we're seeing an improvement here with our intermediate-term oscillators and an improvement, excuse me, and an improvement with our long-term oscillators. Copy curve still negative, but could be getting ready to cross above the red line. We're getting really extreme. We're into the sickly looking green area here with the Sean trend meter. And we're above 50 and going up with the money flow. And we're starting to get extreme with the ultimate oscillator. We're above the moving average with on-balance volume, setting a new high there. We're above 50 with the RSI 14 and 9. That's positive. And we're finally turning back to positive with the bullish percent index. There was enough of an upward move to get back above the moving average. This is one of the primary indicators that was still improving but negative. Now it has switched back to positive. Not much of a change here with the NYSE bullish percent index, and we are improving with the NASDAQ 100 bullish percent index. We're still wondering about this long-term line here, going back to 2009. Is this providing overhead resistance? We're kind of right at that point now. We are positive when we measure different ways of looking at the trend. The Heiken Ashi is positive. The Kagi chart is black and pointing up. That is positive. We're going up with the Renko chart, up with the three-line break chart. Long term, seeing an improvement here with our 150 and 200 period moving averages. They're going back up. And we're negative in the short term with mid caps, but everything else on all time frames are still positive. We're negative with bonds based on price. We're negative with the dollar in the short term. And we had discretionary, which has been suffering a little bit here, and materials ended up being down. Where we had healthcare, another defensive area, it performed the best. And staples, another defensive area. So this wasn't a real growth-led day. This was more of a defensive-led day. And we did have the NASDAQ crossing below 20,000, but then it was able to recoup that. The S&P did set a new all-time high, and we had a BPI cross above 50 with the industrial sector, which is more economically driven. And we're still seeing a bit of a disconnect here. We're going up with the weighted version of the S&P and the equal weighted version, but the red line is still below the bar chart here. That's where we see the disconnect. And we're setting an all-time high with the S&P. That's still not confirmed yet by the NASDAQ. And we're not setting a new all-time high with the equal weight version of the S&P, but we are with the equal weight version of the QQQs, which is the NASDAQ 100. So we're seeing some confirmation here, especially with growth and the big stocks. We're not seeing it across the whole market, at least yet. The Dow's just kind of treading water sideways, but still positive. and it's positive with the Elder's Impulse system after it had been neutral. We're kind of chopping along here, but still positive with the NASDAQ, where we are looking more positive here with the NASDAQ 100. But, you know, it was up 0.05%. I mean, it's not like it's really breaking through the ceiling here. And we're still positive with the Elder's Impulse system for the Qs. The momentum for the NASDAQ 100 is still positive. Then the small caps still cannot get above their 50-day moving average when looking at the S&P 600. And we're right on the moving average when we look at the Russell 2000 small cap index. We had come a little bit above it after Tuesday. Now we're right on it after Wednesday. And they were down 1/3%, but they're still positive with the Elder's Impulse system for the small caps. The mid caps have gone from positive to neutral, and they're right at their 50-day moving average as well. The Wilshire looking pretty good, not up all that strong, but setting a new all-time high. Also setting a new all-time high with the total U.S. stock ETF. The financial sector, little changed, but still looking really solid here. The FANG index ended up being down after setting an all-time high recently. Apple was up 0.16%, still above its 50-day moving average, still under its 50-day moving average with Amazon. Microsoft up 1.25%, but still below its 200-day moving average. Google was up 0.82%, still not back up to its 50-day moving average. Meta taking a bit of profits here, likely, after it set a new all-time high. Nvidia getting back above its 50-day moving average, little changed on the day. And Tesla, which has been getting hit lately, now is starting to bounce back up. Netflix was up. I don't believe that's a new all-time high, but it's really close there. And just wanted to keep an eye on semiconductors. We had come down, and this 250-day moving average had provided support 2 times. And now we're seeing an improvement. And this is a big part of the tech sector. And we're seeing still overall in the short term, when we look at US to world stocks, a bit of an improvement with the correlation between the two. We're still flat with the longer term correlation. Oil ended up going up into the 72 range. Not really, it's been hanging out around the mid to low 70s lately. And the dollar was up, even though it's still below its 50-day moving average. It's still in a longer term uptrend. And we're back up here. We were down just a little bit with interest rates, but we're still coming down to the 50-day moving average, and we're still above this 45, which equates to a 4.5% level. And this is what I've been watching intraday, where we were above it in Tuesday's session. We came down and closed at the low for the session, but we're still above this 4.5% level. And we're going just up a little bit here with the ETF based on price for the 7 to 10-year bond. We're keeping an eye on this. We're just watching Japanese rates just continue to go up. And this is what caused all the problem last summer. Is it going to cause a problem again now? Seeing things hold together okay when we look at the Qs, the S&P still above the moving average. This has been breaking down lately, discretionary to the S&P, and we're right about on the moving average to slightly below when we compare large cap growth to large cap value. So we're below the moving average with the large caps, coming back down to the moving average with the mid caps, and now showing some weakness with the small caps. So what's our outlook? We're still positive, but we're not trending right now. Now, if you wait for something to actually develop into a trend, that's your prerogative, and you're welcome to do that. We're finally seeing more, in fact, all of our primary indicators turning positive, but we're still not trending, and we don't know when we're going to come out of this non-trending environment. We're going to get initial jobless claims and continuing claims, as well as the Philadelphia Fed index, and then the leading economic index will be coming out. And then keeping an eye on all the crazy stuff going on, whether it's within the US or outside of the US. And then on Friday, the big one's probably going to be consumer sentiment for the economic reports. Here's a look at what's coming up for Thursday and then into Friday. And we're pretty negative, though, on a seasonal basis for February 20th. We're neutral to negative with the Dow, where we're just flat out negative with the S&P and NASDAQ. And now we're coming into that part of February, which seasonally Whether you look at the solid lines here or in a post-election year, we typically will see some weakness, but it doesn't mean that's what's going to happen. It's just historically, this is what has happened. So don't be surprised if it does happen. And the second half of February tends to be not a very well performing time of the year. And February is the worst month when we look at a post-election year. This is also showing the second half of February going back to 1950. This is another look at the post-election, how in February things tend to underperform. So the Copic curve is still negative. We have a pretty short list right now. The big question mark is that we're not trending currently. We could be getting ready to cross over positive with the Copic curve, but it's still below its moving average. And so we're looking more positive with our three smart money indicators, but they're pretty extreme right now. And it doesn't necessarily mean a reversal. It just means that we may go back more into this choppy environment or stay in this choppy environment for a bit longer. Growth to value, discretionary to staples are doing okay, but they haven't performed over the last couple of sessions all that well. The advanced decline line, especially for the S&P, when you look at it based on volume, that's looking pretty solid. And we're back to positive with the S&P and NYC McClellan oscillators and summation indexes. We're improving with our oscillators. We're looking better with one of our short-term oscillators. We're still negative, but improving with the other short-term oscillator. We're back to positive in the intermediate term, and we're showing some improvement with the long term there. The swelling trading oscillator going up based on price, going up even better and or stronger based on volume. The parabolic SAR is positive. The vortex, even though it didn't really show any strength, it's still positive. The bullish percent indexes are improving. Ease of movement, the money flow, and the ultimate oscillator, which the ultimate oscillator is now extreme positive. And our moving average studies, short term showing some improvement, a little bit longer term showing a negative divergence from price. The financial sector is positive, as is the momentum for the NASDAQ 100. So our conclusion, I didn't change this because we're just kind of dealing with the same thing. We're positive and not trending. That's what we're seeing in the short and intermediate term, and we continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.